Okay, so picture this. It's a random Tuesday, you pull up your bank app, and you realize you finally have exactly $100 sitting there that you don't immediately need for rent, groceries, or, your phone bill. And you think, okay, this is it. This is my investing era. But the literal second you open your phone, you're just absolutely paralyzed by the chaotic, hustle culture noise screaming at you from every single direction. It feels like everyone online has some secret cheat code for wealth, and you're just sitting there wanting to do this the smart way without lighting your hard-earned cash on fire. Well, welcome to our explainer. Today, we're going to cut right through all that noise and hand you the ultimate no-nonsense blueprint for your very first $100. To get you from totally overwhelmed to feeling completely empowered, we've broken this explainer down into a highly structured, 5-part plan. We'll kick things off by exposing the $100 trap. Then we'll uncover the secret of the behavior gap. After that, we'll introduce the 3 buckets framework, walk you through the exact steps to take today, and finally, show you how to win the mind game.
All right, let's jump right into part 1, the $100 trap, and why it sets up a really dangerous lottery mentality.
Look, if you're feeling anxious about making the wrong move and losing that first $100, let me validate that for you right now. It is incredibly common. The issue here is that $100 is exactly the amount of money people tend to treat like a literal lottery ticket. I mean, you've seen these toxic get-rich-quick posts everywhere, right? Stuff like, turn $100 into $10,000 in 30 days, or buy this one crypto before it explodes. But here's the harsh truth. Chasing those magical shortcuts usually causes beginners to lose their money entirely. And honestly, what's even worse? When you lose your first $100 to a bad gamble, you don't just lose the cash. You lose your confidence and you completely kill your momentum to ever try investing again. So, let's talk about the massive paradigm shift we need to make here. Most beginners stay stuck on that left side, convinced that wealth is all about picking winners, hunting down that one magical penny stock. But true, lasting wealth building, that lives over on the right side. Your first $100 is really just about building a system. It's about turning yourself into the kind of person who invests consistently, calmly, and completely automatically. Actually, scratch the idea of finding the perfect stock. Your goal right now is finding the perfect habit.
Which brings us perfectly into section 2, the behavior gap, where we look at emotions versus returns.
Here is a wild secret the finance industry rarely tells you. The biggest difference between people who actually build wealth and those who don't is almost never about intelligence. It is quite simply about human behavior. Just look at Dalbar's 24 research. It brilliantly illustrates the cost of this. While the overall stock market, like the S&P 500, returned over 25%, the average equity investor only saw a 16.5% return. So why this massive gap? It's not because those investors aren't smart. It's because our human emotions, fear, excitement, a little bit of ego, cause us to panic and sell at the absolute worst possible times or greedily buy in when a trend has already peaked. Seriously, bad behavior absolutely destroys beginners. So how do we protect you from your own emotions? Well, we use section 3, the 3 buckets, a really simple diagnostic framework. Before you even think about buying a single stock or opening one of those flashy brokerage apps, you got to hear this shocking stat from the Federal Reserve. Only about 63% of adults could cover a $400 emergency expense with cash or savings. Meaning, if you invest your only $100 into the stock market today, and then tomorrow your car suddenly breaks down, you're going to be forced to sell your investments to pay the mechanic. And if the market happens to be down that specific day, well, investing didn't help you, it actively hurt you. So, I want you to think of your first $100 as having 3 potential homes. Bucket 1 is safety. If you have 0 emergency savings, putting that $100 into a basic, boring savings account is 100% your best move. Why? Because it prevents a major psychological trap known as loss aversion. Having that safety buffer stops you from panic selling your future investments when a stressful surprise bill inevitably hits. Then bucket 2 is high interest debt, and bucket 3 is actual investing. Let's zoom in on bucket 2 for a second. Now, what's really fascinating about this is it's the mathematical proof of why paying down high-interest debt is absolutely the smartest first investment you can make. If you're carrying credit card debt charging, say, 25% interest, putting your $100 straight toward that debt gives you a guaranteed 25% return. Boom. The stock market does not guarantee anything close to that. If your second bucket has a giant hole in it, you've got to plug it before you do anything else. Okay. But let's assume your safety buffer is fully funded and your high-interest debt is totally wiped out. Awesome. You are finally ready for bucket 3, actual investing. The absolutely crucial point here is that when you hit this stage, you shouldn't suddenly act like you're playing roulette. Your first $100 shouldn't go into a meme coin. It should go into a broad index fund. Basically, this means you're buying the entire market at a very low cost. You literally get to own a tiny slice of thousands of successful companies all at once. And considering research consistently shows that the vast majority of professional, full-time money managers can't even beat these broad indexes over time. Yeah, as a beginner, this is absolutely your strongest possible move.
All right, we understand the overall strategy. Now let's shift into Section 4, the exact steps. This is your literal execution playbook.
If you've been waiting for the literal step-by-step on what buttons to press, here we go. Let's build this system. Step 1. Choose the right account. This is usually an employer match like a 401k, a tax-advantaged retirement account like an IRA, or a regular brokerage, but always aim for the lowest fees. Step 2. Choose one fund. Seriously, don't overcomplicate it. Just pick one broad index fund or a target date fund. Step 3. Actually invest the $100. And hey, thanks to fractional shares nowadays, you can buy in even if a single full share costs way more than $100. And finally, Step 4, which is the most vital one by far, automate the next contribution.
Why am I stressing Step 4 so much? Because of the staggering, almost unbelievable magic of compounding. If you invest $100 just once at a 7% real return and do literally nothing else for 30 years, it grows to about $760, which is nice, sure, but not exactly life-changing. But if you automate just $25 a week for those same 30 years, you end up with roughly $120,000. That right there proves why the initial $100 barely matters compared to the habit itself. Automation beats motivation every single time.
But hey, while you're setting up all this great automation, you have to watch out for the silent killer of investing: fees. This comparison is just mind-blowing. An actively managed fund might charge a 1% fee, while a boring, regular index fund might charge just 0.05%. And I know, that difference sounds completely microscopic right now, right? But over decades, that tiny fee literally eats your compounding growth alive. Choosing a low-fee index fund can actually leave your portfolio over 30% larger over the long haul. So please, keep your fees as close to zero as humanly possible.
Finally, let's wrap this whole thing up with Section 5, winning the mind game. System versus emotion. So if everything we just talked about is so brilliantly simple, fund a safety buffer, kill high-interest debt, buy a broad index fund, and automate it, why doesn't everyone just do it? Why do people abandon the system? Well, it's because your brain actively works against you. First up, your brain craves excitement. Staring at an index fund going up a steady 7% a year is super boring, while day trading meme stocks feels like being at a thrilling casino. Second, your brain absolutely hates being wrong, which leads you to panic sell the literal second you see red in your account. And third, your brain wants control. Picking an individual stock gives you this illusion of being in the driver's seat. But you have to remember this one fact. In investing, ironically, doing less, staying completely hands-off, and being utterly unapologetically boring is the ultimate winning strategy.
So I want to leave you with a powerful challenge. I call it the 24-hour challenge. You know, most people never end up investing their first $100 because they're forever waiting for the perfect time. But the perfect time is today. So in the next 24 hours, I want you to pick your bucket. Either put your $100 into an emergency safety buffer, invest it into a broad index fund, or at the very least, just set up your brokerage account and automate a simple $10 deposit. Just take action. Because ultimately, the money isn't even the biggest thing that changes. When you build these boring, highly profitable systems,